Okay, are you ready to go?
Yes.
So, this is basically, well, these are not slides from the textbook, not slides from the course how we usually do it, but the slides that I use for my M&A students in my M&A class. So after having taken the introductory corporate finance class, I basically take this as a starting point to introduce them in a practical valuation how investment bankers do it. And a lot of things will be repeated because, of course, the textbook already had all the formulas and we can quickly jump over it, but there were also many new things that gives you a more practical point on this. So first of all, if you want to become an M&A banker, you think, I want to do M&A, mergers and acquisitions. So I basically buy and sell firms or help other people buying and selling firms. Why then I do become a valuation expert? Why actually do investment bankers all start with corporate valuation? It's because this is really the core of the M&A business. If you start there as an analyst, corporate valuation will be the most of what you do in the first years. The deal makers are senior people. They talk to the executives and they make the deal, they negotiate. And the input that they need from the analyst, and you will start as an analyst in that industry, is to a large part valuation. For example, a customer may require a fairness opinion. A typical example, there was a takeover offer. Like recently, Elon Musk publicly announced that he would like to take over OpenAI for $100 billion. And the founder of OpenAI basically said, no, never ever. We are going to sell ourselves. Mr. Altman can say this, but if this happens to a normal company, then basically the company is required to basically have a recommendation. We recommend to our shareholders, please do not sell your shares. We do not want to be taken over. And of course nobody believes them because they just want to keep their jobs. So they hire an investment bank and they do a fairness opinion. And the fairness opinion is nothing else than the reasoning behind the required recommendation or not recommendation. So a fairness opinion is a valuation by an investment bank when somebody needs a fair valuation opinion. So if you want to tell to your own shareholders, please say no to the takeover offer, don't sell your shares, then you need a fairness opinion quite often. Or if you are the CEO of a public company and you want to take over somebody else, and you say, I launched a takeover offer of maybe 100 million for OpenAI. Then the shareholders may sue you and say, he is wasting our money, he is paying way too much. He seems an empire builder, and he's making bad deals just for his personal pleasure. Then, if you can say no, I have a fairness opinion by J.P. Morgan or by Morgan Stanley, and they told me that the value is okay. Then basically he doesn't have any legal liabilities or the threat of legal liabilities. So fairness opinions are basically valuations by investment bankers done for people that do recommendations to accept or not to accept, or on people acquiring a firm and offering a certain payment just in order to make sure that they do not overpay or make wrong recommendations. Quite often M&A lands in litigation. It ends in litigation in front of the court. Simply because some shareholders are so upset that they call the court and sue the manager and say we want more money. And the Dell case on the next slide is one example. Maybe we just switch over there. This is really an interesting case. Do you know Dell Computers? Probably. And you may know Michael Dell. He was the founder of Dell Computers. Initially, it was his firm. Then over time, it became wider and wider dispersed. And then basically he decided to buy back his own firm. So in an average buyout, together with large private equity firms, he basically bought his own firm back. Yeah? So from maybe 5% back to 50%. Yeah? He wanted control. And then the deal was taken to the Delaware court in 2016 by unsatisfied shareholders, who basically said, we did not receive enough. Yeah? They were squeezed out, they had to sell their shares in a kind of merger. Yeah. And then the transaction closed at $13.75, yeah? And a fair value based on the LBO model. This is just another variant of the discounted cash flow model, yeah, that you already saw here. The value was materially higher. Yeah? Basically, they had access to documents used by Dell, and they showed much higher numbers. Yeah? And in particular, if the court said that the DCF model is more reflective of fair value than an LBO, and basically said two models from Mr. Dell's defense are the relevant ones, yeah, and they conclude 16 point something and 18 point something is the fair value. Yeah, so basically in the court, you open up all the files of information, and you ask what was the basis of the valuation by Mr. Dell, and then you see lots of different valuation, and you see something of a DCF model and an LBO model, and the court basically said, I take the DCF models, and Mr. Dell, in his own DCF models that are publicly known, had valued the firm much higher. Yeah? But he offered only 13 to the shareholders. Yeah? And then the difference was paid to the shareholders. Yeah? So this was a great victory for the shareholders. And they got a takeover offer. Well, Mr. Dell basically said, my shares, my Dell shares were trading at below 10 before the transaction. Yeah? Then I offered a nice premium and offered them a high price of 13.75. And Mr. Dell said, and the majority of the shareholders accepted this kind of offer. Yeah? And then basically I bought all the shares for this price. Yeah? And then some shareholders basically complained and said, yeah, we were forced to sell in this transaction and we were not paid adequately. Yeah? And just look at the documents that Mr. Dell used in the transaction, look at the valuations by the investment bankers, and you see that the true value was much higher. Yeah? And the court said, yes, and we're talking about billions of money here. Yeah? This is a large computer firm, and many shareholders received $3 each share. So in front of the courts, yeah, the courts spent time in looking into the details of these models, yeah, and sometimes basically order that Mr. Dell in this case had to pay a large penalty and extra payment for the shareholders. Yeah, when you are an investment bank, ID stands for investment bank. Yeah? When the investment bank pitches for a sell-side mandate, sell-side is somebody wants to sell something. Yeah? For example, Siemens is a conglomerate that has lots of different units and almost every year sells something. Yeah? And what they sell is huge firms. Yeah? Conglomerate is a giant firm, yeah? And when they sell them their computer assets or their wind energy assets or their healthcare assets, yeah? This is a firm. And when you pitch for them, of course, you want to convince Siemens, please sell your healthcare unit. Yeah? We believe that we can sell this at a very nice price. And then as an investment bank, you want to discuss the likely price. Yeah? If you would sell this, this is what we believe you can get. And of course, you also signal competence. Yeah? We understand your business. Yeah? We understand how to value this. And with our argumentation, we will be able to convince potential buyers. Yeah? Because when Siemens decides to sell, the investment bank has to find a buyer. And therefore, this is basically the start of a discussion process. Pitching means when Siemens wants to sell something, they ask at least 4 or 5 investment banks to do the pitch. And this is like a beauty contest. And only the best investment bank will be selected. And if you think about what is the basis of selecting an investment bank for an M&A transaction, of course, Siemens want a high price, but if you are too optimistic, Yeah, of course, before the deal, everybody is very optimistic, yeah, and the highest price will probably not be the winning price. Yeah, it is really that you have a good investment banker team, and that this investment team basically signals competence and customer contacts and knowledge in this area. Yeah, and that's why competitors in the industry are always very important. Yeah? Investment bankers must create the impression, at least, yeah, that they know by heart all the investors, all the other firms that also are in the healthcare industry, all the recent trends, what the investors like and what they don't like, and how to basically present this company. Quite often, it's like when you sell a house. When you go with a broker through the house, he said, oh, you should put some more paint in here, you should put a nice picture on the wall, then the house looks much better. When Siemens sells its healthcare business, they will do also some kind of restructuring. And before they actually sell this, and the investment banker basically says, very much like the real estate agent, what kind of restructurings are necessary, such that this is a beautiful ride, so to speak, for the capital market. Yeah, of course, with evaluation, you also convince buyers. You said, dear buyers, please buy the healthcare section of Siemens. This is what we believe could be sensible prices. And of course, then you try to convince them that this is a good investment, that there is an upside opportunity. And you would say, if certain things happen in the future, this will translate into a higher stock price, for example. And you always start, of course, with the as-is valuation, and then for the buyers, you may add something like the potential higher prices that you could receive. You could pitch for a buy-side mandate. It's not so often. Some rich people basically say, I urgently need to invest my money. Who is the investment banker who basically selects companies which I buy? This is and you should never forget, an investment banker is like a broker. He wants to get the deal done. He is not interested in what the right price is. Suppose an investment banker says, I believe that the fair price of the Siemens healthcare business is 100 billion. And Siemens basically said, no, but we want to sell only for 110. You are out. That is the bad news for the investment banker. You should, if somebody tries, is optimistic that he can achieve 110, then you do not want to rule out 110 completely. In the end, you try to convince him that 110 may be a bit too aggressive, but if he really believes, and if he is lucky and finds somebody, why should you prevent him from saying 110? If you're too optimistic, and then the buyers come and say, well, you said 110 is the value, but why should I pay so much? In the end, a buyer must have the impression that he makes a good transaction, that the true value is above the price. And the seller, of course, should think that the true value is below the price. Everybody wants to have an advantage. Siemens must think that they benefit, and the buyer must also think that they benefit. And if you just say the true value is 100, full stop, then you can easily kill a deal. So never even think about that the investment banker will tell you what the right price is. Quite often people say, you are an expert, please give me just one number. What do you think is the price? Investment bankers will use 20 minutes at least to argue why this is not a good question. And they refrain from basically telling you a precise price estimate, simply because this may be easily killing the transaction. This is how they present this. This is from Citigroup. Citigroup is one of the top 5 global investment banks. They operate in all continents. And sorry that this is a bit smaller to read. DCF, which is the only part in our textbook, is just one line here. And it's not one point estimate, basically they say between 31 in 44 is our DCF estimate. So they basically say, even with DCF, you get a range of possible values. And then there were lots of multiples. Firm value over sales, firm value over EBITDA, earnings before interest, tax, and depreciation. And again, you have intervals of possible numbers. So the investment banks basically did three things here. They selected two multiples, firm value over sales and firm value over EBITDA, and not other multiples. There are many, many multiples that practitioners use, and they pick these two. Then they decided EBITDA is with an A, and there are so many different abbreviations, but if you just ask what is A EBITDA, then ChatGPT will probably say this is adjusted EBITDA. You adjust for some extraordinary things that affected only the last year or only the next year, and that you should basically ignore. Secondly, here is an E, and there were two same multiples. Sales over firm value and EBITDA over firm value 23 and 24. So this presentation was done in 22, and the E stands for expected. When we value something with multiple, we basically say if the sales is 100 and the firm value is 200, then sales over firm value obviously is 0.5. And if we have a company, sales of company E is 300, then we would conjecture the firm value of company E is obviously 150. We simply, this is basically so. Corey's saying the health sector of Siemens is only a segment of Siemens. It doesn't have any comparable firms. Nobody knows what this health sector is worth. But there are comparable firms, and they have sales and they have firm values. And on average, they trade at the firm value is 50% of the sales. And you apply this and conjecture Siemens Healthineers, the healthcare unit should be worth 150. When we read this in the textbook, sales is past sales. In every textbook, you say, look to the financial accounts, look what the sales are, and then put this into the multiples analysis. Investment bankers usually have E-sales, and E-sales means expected by analysts. Investment banks deeply believe that analysts play a big role in the market. On Bloomberg, you can read all the analyst estimates, and if the analysts believe that next year sales will be something, or the year afterwards, so today it would be, we're at the beginning of 25, and today people would say 25 expected sales and 26 expected sales. That would count, and that would be, from comparable firms, you would take the expected sales this year and next year from Bloomberg, you would look at the firm values in the stock market, and then you would derive a multiple from this. So investment bankers use a lot of multiples. They select the appropriate multiples, and then instead of using historical figures for sales or here for EBITDA, they quite often use expected this year or next year figures that are not yet completed. And sometimes they do an adjustment here because they say there are extraordinary things that affect these sales that it should not affect the firm value. Then there is something called broker target price. Basically they say when a customer like Siemens, if a firm is traded in the market, here we have HelloFresh. This is a relatively young firm that basically delivers food from the restaurants to the homes, or they also cook own food and deliver this to the home. So it's a kind of meal preparing and meal deliveries company. Quite successful, also globally operating from Berlin. And the broker target price is simply what the analysts, called brokers here, expect for the next year for this thing. Brokers analyze the firm very intensively, write long reports about this. And one thing that they also produce is the so-called target price. The median broker target price is 31 here. And the range is between 16 and 41. Again, for me it's always surprising how big the ranges are. Because the investment bankers basically do not want to be too precise. They leave a large margin open in order to basically say there is nothing like the true value of that thing. There is a large range of possible values, and therefore a large range where possibly buyers and sellers could agree on a transaction. And we want to give some guidance here, but we do not want to be pre-justice, and we leave it up to the seller and the buyer to basically determine their own valuation. And then the first one here is trading metrics. The last year, 42 weeks. That is basically the last year up to now. And the share price is simply trading between 50.9 and 34. And then basically they do something like, they include here the green line is the share price. This was in October 23. I always do my M&A class in October, so this was brand new figures in 23. And in 23, of course, the full year figures were almost done. 3 quarters were already clear, but the year-end figures of the last quarter were not yet clear, so this is also an expected kind of figure. But these sales were basically 3 quarters were already booked, and then there is less uncertainty. But these sales in 24, 1 year behind, before 1 year more in the future, was of course completely unknown, and only an analyst estimate. And then they compare the share price with what they believe is something like the average of this. You have this purple area here, is where they think this is where most of the things lie, and this would be then somewhere between, I don't know, something between 24 and 34 or so. And then they basically conclude, the green price, the current share price is somewhat below what most other methods show. And this is nothing else than saying the stock looks a little bit cheap in the market. And you can use this for many things. You can use this as an invitation for potential private equity firms. Look, this could be an interesting target to be acquired in a private equity transaction. And then the private equity fund could say, okay, dear Citigroup, I give you a mandate, please create a team of people and prepare a takeover offer and do an intensive due diligence and try basically to go deeper into the understanding, and we want to understand more deeply whatever this undervaluation really happens. Or you can go to HelloFresh and say, dear HelloFresh, look, your stock price is rather low. You look like a target. You are threatened by a takeover. Please call the Citigroup team, and we will help you to drive your share price up. Because you are under threat of being taken over. So the valuation is the starting point of many things, and quite often things that create earnings for the investment bankers. Investment bankers need to be hired, they want to work for you, and they work for all kinds of different mandates. One is, of course, in an M&A transaction. They work either for the seller or the buyer and advise him, and the valuation is a part of this. Or they work on a defense mandate, like they want to prevent HelloFresh from being taken over, and then the valuation is the starting point of the discussion. You need to do something about your share price. You need to bring this up. We will evaluate different things, like a share repurchase, an extra dividend, some kind of restructuring. And given our market knowledge, we can tell you how we believe that you can bring up your share price. So the valuation is basically the starting point of hopefully receiving a mandate, hopefully triggering M&A transactions or so forth. And then the implied share price is translated into the equity value. This is the midpoint equity value and the firm value. So if this share price here is true, then the equity is worth 7.4 billion and the firm is worth 7.6 billion. HelloFresh has almost no debt. And it's also translated into a multiple over EBITDA. If you buy the firm, if you would, for example, pay 31.9 per share, the lower end of the DCF, then this would mean that you pay 11 times EBITDA, and if you pay this amount of money, you pay 50 times EBITDA. And this last second is simply because this is how private equity firms judge on firms. If private equity firms must compare 10 different target firms, they are not interested whether the share price is 31 or 42. They are not interested in whether the equity market cap is 7.1 or so. They say, if we can enter for 11 times EBITDA, this is something that we understand. Then we can compare with other firms. Because in this industry, we believe that an average firm trades at something like 12 or 13 times EBITDA. If we can buy this for 11 times EBITDA, that looks like a bargain price. It's simply that the EBITDA in the private equity firm is the by far most dominantly used multiple. So it's the same that is used also here. Here, the firms are trading at EBITDA multiples, but we don't see what the multiples are. And here, if you translate this into the multiples. So if you pay $24 per share, this means that and if you buy the whole firm, including the debt, that translated to 8.6 times EBITDA. So investment bankers simply translate the values into the numbers that people are used to. And private equity firms always want to know this multiple. Some people want to know the total market cap, how many billions is the company worth, and shareholders, of course, want to know the share price. Shareholders see the current share price of 21 and want to understand where the share price would be if the market uses this or that multiple or whatever method. It's called the football field, and it's basically the first valuation page. And then basically every method is explained in detail. But this is basically how Citigroup and I think all the other investment banks are very similar. They all start with an overview of different valuation methods, and from case to case and from time to time the methods of course change, depending on the industry. Different multiples may play a role, obviously, but it's always a large part. And then, the DCF valuation clearly is the most important thing. And sorry that it's so small, but I think on the next, this actually looks like our textbook, very much, and some of the lines are identical to the textbook. Also, our textbook had EBIT and sales and so forth. What they have added is a percent margin. So EBIT is 601 here. Is 601 very large or very low? Difficult to estimate. Is this optimistic or is it rather pessimistic? The EBITDA margin is much better to evaluate this. This is 6.6% EBITDA margin. So for every dollar in sales revenues, we expect to create an EBIT of 6.6%. This is something that practitioners can evaluate. People have a gut feeling for this industry, Yeah, they know that for every dollar of revenue, yeah, in the health in the meal preparation business, yeah, something like 6.6 is rather low or average or reasonable. Yeah? That is expected to go to 6 to 7.6%. Yeah? So they add some numbers that are needed for practitioners to evaluate whether it makes sense, yeah? Whether it's rather optimistic or pessimistic. Yeah? And these percentage numbers, yeah, with the sales, of course, you have the year-on-year growth. Yeah? And yeah, when people are too optimistic, they basically assume a high growth. Yeah? Just looking at the figures is not so interesting. Yeah? But here to have an 8.8% growth in 2025, yeah, that's where many people say that's a bit too much. Yeah? I'm a bit more pessimistic here. Yeah? So you supplement the spreadsheet with numbers that help experienced investors to see whether the numbers make sense. Yeah? That's the whole thing. And then they have something like sensitivity. Yeah? And that's interesting. Basically they say, we don't know what the WACC is. Yeah? The textbook is very clear. If you just follow our textbook, it should be clear, yeah, what the CAPM and the traditional methods say. Yeah? But they say, we have no idea. It could be somewhere between 8.7 and 12.7. Yeah? And please choose yourself. And we are also not certain about the perpetuity growth rate. Yeah? So after the planning horizon, after these years here, terminal value, up to 2032, 32 is 10 years from now. Yeah? So they do a 10-year projection, and then they assume that the terminal value is coming from the Gordon growth formula. Yeah? But they say, we don't know. We could put something between 1 and 3% into this formula. And depending on what you put in here, the results are different. Yeah? So the midpoint, yeah, 10.7, 2% growth rate, that seems to be their point estimate. Yeah? But if somebody is more optimistic on the growth rate, yeah, you can easily add another 15% on firm value, yeah, that comes from this higher G. Or if you believe that the WACC is cheaper, and that the cost of capital is only 8%, you can again increase the value from 6.6 to 8.7 just by changing the WACC. Yeah? So this basically informs the seller and the buyer that it all depends on what the true cost of capital is and what the ultimate growth rate will be after 10 years. And basically helps. Suppose they would say, oh, they would only signal this number here. Yeah? Then they would say 6.6 is the firm value. Yeah? And then if somebody pays more than 6.6, because there were so many potential buyers, the buyer has the impression that he overpays. Yeah? And then he has to explain back home, yeah, why did you pay so much? Yeah? With this format, yeah, nobody pays too much. Whatever you pay, you can always say, yeah, there was much competition, so many people wanted to buy that firm, I had to pay a really high amount of money, but it's still not too much. If we are a bit optimistic here and a bit optimistic there, yeah, then I still got a nice price. Yeah? I paid less than 9.8. Yeah? And of course, investment bankers make sure that the highest number here will always be above, and the smallest number here, yeah, between 5 and 9, has a huge range of numbers. Yeah, so if there was lots of competition, yeah, the price will probably never run above 9.8. Yeah, and then every buyer can always say, yeah, I didn't pay the highest price or an overpriced thing. Yeah? And the same thing with the share price. Yeah? If you use this DCF with different WACC and different perpetuity growth rates, you produce share prices. Yeah? And the middle is 37, yeah, which is already $20 above the current share price. Current share price was 21. Yeah? So the DCF basically says, the midpoint here, 21 to 37. Yeah, this is a huge, huge impact. Yeah? The investment bankers really believe that the share is severely undervalued. Yeah, 21 to 37. Yeah, and that the values range somewhere between 28 and 55. Yeah, depending on what you put into it. Yeah, and then, of course, the DCF valuation first brings the firm value, 6.6 billion. Yeah? And that is the sum of two things. Yeah? These cash flows here have a value, yeah, that makes 3 billion, and the terminal value adds another 3.5 billion. Yeah? So you can easily see how much of the value is, so to speak, easily plannable. Yeah? The next 10 years, that's where you assume that you can forecast the future rather precisely. Yeah? But the value of the firm after 10 years, this is of course quite uncertain. Yeah? And the uncertain part is basically separated from the more certain part in order to also signal how much you can rely on this. Yeah? And then there are firms, more mature firms where only a small part comes from the terminal value, but there are also unprofitable growth firms where a large part basically comes from the terminal value. And by making this transparent, and you also tell the reader of this report how much you can rely on the report. Yeah. And then you have firm value adjustments that translate firm value into equity value. And firm value adjustments is what in the textbook was called net debt. Yeah? You add the cash, you subtract the debt. Yeah? But these adjustments are much more in reality. Now, on the latest slide, you will see these adjustments broken down more in more detail. Yeah? And these adjustments are a topic of quite often long debates, yeah? Because it's not really clear what is equity, what is debt, and what are these provisions, yeah, that do not count as debt. So, so there was an extra slide on these firm value adjustments later on, yeah, and this is important. Yeah, here it is small in magnitude, but still quite often important. And then this is the number of shares outstanding. And this is another hotly debated thing. Because if you just Google how many shares are outstanding, or if you ask, if you read a financial report, you quite often see at least 2, 3, sometimes 4 or 5 different concepts. Yeah? If all the stock options are exercised, if the treasury shares are sold, if the capital increase that is already announced is really taken through, and many other things. Yeah? So there are many ifs. There may be convertible bonds or warrants outstanding. Yeah? They could be exercised, and yeah, the number of shares outstanding is really the answer of many questions, or depending on many questions. In particular, yeah, if you have financial instruments like options that you can translate into shares. Yeah? For example, you may have the fact that the management has management stock options as an incentive, and when this company is taken over, he will be fired. Yeah? So he will exercise his stock options, create more shares, and of course sell these shares. Yeah? Then it is reasonable to assume that these stock options count like shares. Yeah? They will be exercised in the event of a takeover. Yeah? But they may be a convertible bond that basically says if HelloFresh is close to bankruptcy, the bondholders have the right to convert this bond into shares. Yeah? But the incentive is such that only in a bankruptcy situation, yeah, they should do this, because maybe the contract is structured so that normally the bond is more attractive. Yeah? Then of course it doesn't make sense to assume that this will be converted, yeah? Because it's unlikely to be converted in a takeover situation. Yeah? So the number of shares in a real world situation means you analyze all these things in detail and then decide, yeah, whether it is relevant for the takeover. Because in the end, this firm value, of course, should be the amount of money that people has to put on the table in order to buy all these shares. Yeah? So how many shares are there to be bought in the case of a takeover. Yeah, and then this gives you the implied share price. And then you compare with the current share price, and you say 75% is the undervaluation of the current share price. So this looks like an interesting target. Yeah, and one last thing, sales, EBITDA, EBIT, and then basically already, change in working capital, CapEx, the same thing that we also had in the textbook, and then the free cash flow. This is almost identical to the textbook, and the only question is, where do the numbers fall? Did somebody basically say, oh, what is the CapEx of HelloFresh in 2031? And somebody guessed it is 322. Where does this guess come from? Nobody can tell you the investments in 10 years from now, but somebody has estimated this. And so we have to look into the details on how this may be constructed. First of all, you have to choose the key input figures that you show. I think if you work for Citigroup, that is almost already determined for you. Depending on industry, there were templates. And then there was a template for traditional industry firms, there was a template for banks, there was a template for startup companies like HelloFresh. Simply because Citigroup believes that this is the most important figures for this kind of corporation. If you analyze Continental, you may think, you may just read through other people's report and then conjecture yourself. What do you think is the most likely, the most important thing to put here? Then the most important assumptions is actually the margins. Profitability margins, sales growth margins. These are basically assumptions in the model, and you put it on the paper in order to make transparent what your assumptions are. And then you present sensitivity analysis because you don't want to be in a point estimate. You want to be a bit open, such that to leave up a good negotiation space between the buyer and the seller, just because otherwise the deal could not be closed, and you will be paid only if the deal is done. Of course, this was done by, I have to say very precisely, this was done by a student who did an internship at Citigroup, with, of course, all the technology, and with the help of senior experts at Citigroup. And they say this is basically equivalent to the valuation that we would do if we are just invited to present our view on HelloFresh. So if HelloFresh says, we want to talk to our Citigroup bankers, what they believe and what they think is urgent, and then Citigroup banker would say, this is the normal analysis that we do, and by the way, we found that you have a real problem, your stock price is way too low, you may be taken over. Then basically this is, of course, the entry of more business. But this is actually a rather standardized kind of business. And if you really work on a transaction, you may have access to due diligence data by JP Morgan, by McKinsey or Boston Consulting Group. You may have access to more inside information, and then you may also put this into the spreadsheet. This spreadsheet, interesting enough, in some years in the past, all these spreadsheets started in the following way. Basically, they said, past, for example, 2023, 2024, and then future, 2025, and so forth. And then you could see the past figures, and you could see how they were extrapolated. And then you can see how reasonable this is. Here they don't report the past at all. We are in 23, and they start with 24. But they start with broker estimates. And broker estimates are, so to speak, neutral. Actually, I would like to see also the past. Because all brokers could also be simply too optimistic. If I have a projection, I want to compare the projection with the past. If in the past the EBITDA margin was always around 5%, and now all of a sudden the projection has much higher EBITDA margins, that sounds too optimistic. But they actually don't disclose the past at all. But quite often this is done. It's only in this case. But the time when you have broker estimates, and for this time there were simply no broker estimates available, obviously. Because investment bankers usually say, if there is something that is neutral and it is relevant, and brokers and analysts are neutral, then of course I take their expectations. Because I am likely to be accused to be too optimistic or too pessimistic. So if possible, I try basically to have neutral experts give the estimations. And of course, a private equity firm would then send a consultancy company into this company, and then they say, we believe that you can drive up the sales by 10% if you change something. But this is then another expert that you rely on. If you're an investment banker, you usually don't say that you know the world better than others. You don't say, I am optimistic and I believe that the sales can go by 10%. Everything that you do should be based on some kind of evidence in order to make this plausible. One plausibility comes from just extrapolating the past. You see a mature firm in the past had always been stably fluctuating at the profit margins, for example. They were 10%, and you just extrapolate this into the future. Or you have analysts, trusted experts, that publish their estimates in the market, and you put this into it. And if you do your own estimate, basically you try to be, not conservative, but neither optimistic nor pessimistic. There should be something that is unbiased, which is the expected case. And if you say, for example, the sales growth starts at 9% and ends at 2.5%. So one of the key things here in the spreadsheet is really that the sales growth declines over time. And 2.5% at the end. And this is of course then ending in the perpetual growth phase, simply means that a startup like HelloFresh becomes more mature over time. And the average firm, of course, grows with the GDP growth rate. In Germany, the GDP growth rate is roughly, what kind of GDP growth rate do we have here? Well, if you read the GDP growth rate in the press, this is after inflation adjustment, which is the real growth rate. If you have GDP growth of 1% plus inflation of 2%, you have aggregate growth of 3%. And here we calculate not inflation adjusted. This is all nominal figures. And therefore, this growth rate, I would say 3% is actually not very optimistic. Many investment bankers say 2% is more realistic, but 2% is only the inflation rate. If you sell exactly the same amount of meals, and if you just adjust the prices for inflation, you already have 2% growth rate. So my gut feeling is that this is clearly too low. The European Central Bank has clearly indicated that their target inflation rate is 2%. The central bank does everything in order to put inflation somewhere in the area of 2%. And then, even with no economic growth, with zero GDP growth, the cash flows, like sales, would increase with 2%. But I actually asked the investment bankers exactly that question, and actually I found out that they don't even know that GDP growth is a real growth figure. They basically said 2% is a good long-term growth estimate, because our GDP growth is around 2%. That is, I think it shows how uneducated real world investment bankers are. Because here we talk about GDP growth plus inflation, and GDP growth in Germany is on average no more than 1%. We are a mature society with a declining workforce. There were more people become pensioners than there were young people starting their business. And if then the workforce is declining, only technical progress can still generate economic growth. And I think with 1% we can have a very nice living. In Vietnam, of course, the numbers look completely different, but not because you are growing faster. It's simply because more young people enter the labor market every year and start becoming productive. And in Germany, the retirements basically dominate young people starting. As an interesting standpoint, when China has a growth rate of below 8%, they really are in economic trouble because they can't feed their young people. When Germany has a growth rate of 1%, we are very happy because we can sustain our way of living, simply because there are no young people searching jobs and needing this GDP growth in order to be fed. So this was the DCF analysis. And if you go back to the textbook, well, this looks almost like our textbook. This is basically the cookbook receipt, how you use it, and then the key question is how you forecast this. And the forecast is usually based on historical data or on analyst expectations from Bloomberg or IBES, which is just a part of Bloomberg. And then, of course, you add the taxes and the net working capital and the CapEx. And then you get the free cash flow. And I explain to my students what this means, and you already know this already, so we can be quite short on this. The CapEx, capital expenditures, this is the new investment into long-term capital, like machines and factories. In the real world, it's quite often based on the management plan. So if you value, for example, HelloFresh, you may simply ask HelloFresh, do you have a capital expenditure plan for the next 5 years? And if there is a plan, you can simply use this. And if you don't have access to this, only if you don't have access to this plan, you must do an own investigation. And of course then, if you plan for new machines, well, the sales and the EBITDA, especially the sales, should be consistent with CapEx. One very simple thing, you have 10 machines, they produce 100 cars each. That is the maximum capacity. Then you can produce 1,000 cars, but no more. If you expect your sales to increase by 10%, that means you need to produce 10% more cars. That means you need one more machine. Very simple. If you increase your sales by another 10%, you need another machine. So the sales is basically how much cars you want to sell, and the CapEx is the number of machines that you need for this. And although you have no idea what precisely they sell and what precisely the amount of machines is, you should at least use some rules of thumb to be consistent. As a simple rule, if you want to double the sales, you usually also have to double the machine park. That's a very simple rule. But if the machine park is already written down, the machine park that you see on the balance sheet is only 50% of the original purchase price, because of depreciation. Then of course the CapEx is twice the book value of the machines. You want to double the production capacity. You see maybe 500 is the book value of the machines, and you need to invest 1,000. Because the price of new machines is much higher. So this is a kind of thoughts that you need to have when you do the analysis. And oops, Yeah? And then, of course, if you go through this thing, all these errors means you have an estimation problem. Yeah? How do I forecast the revenues? How do I forecast the cost of goods sold? How do I forecast depreciation and these things? Yeah? And the next slide just gives you a very simple, the easiest to think about model how to do it. Yeah? Revenue growth, we can simply say A%, maybe 3% sales growth every year. Or you can say A1 until 10 years and A2 after 10 years. Yeah? Or like you saw just with HelloFresh, it starts at 10% and then it gradually goes down to 2%. Yeah? So obviously, they just have in mind the long-term growth rate and make sure that the company basically migrates slowly to this long-term rate. It is in the end, at least you need an A, one number, which you feed into your spreadsheet. Cost of goods sold and SG&A is selling, general and administration. That's just another name for the overhead costs. In the easiest case, you simply say this is a certain percentage of the revenues. And then you may look at the past and say in the last years it was 10% of revenues. I simply assume that it will stay at 10% of the revenues for the future. And working capital is also quite often assumed to be a certain percentage of revenue. Because if you sell 10 more or twice as many clothes, you need twice as much of inventory, for example. And the same thing with PPE, property, plant and equipment, the investment into machines. Just assume that if revenue doubles, you have to think about this thing. Depreciation, a percentage of property, plant and equipment, is basically the average duration. If all machines last for 10 years, then 10% basically is the average depreciation. Let's leave it here. You are over time already, and I will bore you with this. This is where we will start tomorrow. So tomorrow we will continue with this, making you fit for the weekend. We will also talk about the time case. I hope that you all have time until then to read the time case and discuss a little bit the case solution. Okay, thanks you and see you tomorrow.